Sound check, sound check. 1 2 1 2. Let me know if the volume sounds good. It should be good. We got the FOMC meeting live in an hour, guys. 1 hour until the FOMC meeting goes live. Let me know how you feel about this report. Very big report, very relevant report. We're gonna get our timer up. Get ready for that. We're gonna look at the Nasdaq, which has been on a little bit of a bounce back here today. Been on a little bit of a bounce back. We got Microsoft, AMD, Tesla still pushing up a little bit, almost green on the day, I should say. And yeah, you got the Nasdaq 100 on the left side here trying to move. So again, we're going to put all this stuff up. We're going to put some music up as well here. Let me find, what do we want to listen to? I'm going to go to some really old songs that I haven't listened to in a while. We got this big, long playlist, bro. This playlist is like literal days. Let's keep going. Yeah, it's just so old. All right, we're going to start here. All right. What's up, Daphne? I agree. Continued pause. Mom watches. Aloha. What's up, Constantine? What's up, Pawn? All right, so we're here. Again, FOMC decision today. The FOMC's rate decision will go live right at 2 p.m. Eastern Standard Time right here on the stream. We will also stream the Jerome Powell interview conference at 2:30 p.m. Eastern Standard Time right here in its entirety. Put that up just so people understand, and then you guys ready? I'm ready, man. I'm excited. This is usually a very volatile day. Can y'all hear the music? You should be able to. If you can't, let me know. Well, equities are actually green today, which is a shock. Again, you can kind of see the Nasdaq starting to find its way back up. Let me see if I can put the volume weighted average price up on this chart. Put the 1 day volume weighted average price. Yeah, you can see the Nasdaq starting to break over that level. So we're getting a little bit of a bounce back. I wonder if I could take off one of these upper or lower bands. I don't necessarily want the upper and lower bands. There we go. That's better. And yeah, you can see the Nasdaq starting to push up. We got the yellow volume weighted average price. I also want to put the 200 EMA up on the chart. Let's see. We'll put a timer up here as well. We got about 40. Or no, I'm sorry. Oops. A little bit off with my time here. Let me pause and click. 57 minutes is the true time. There we go. So we got about 57 minutes left until this goes live. Let's see. Can I put up indicators this way? Okay. We want the 200 exponential. We're going to make this one yellow. Yeah. And then for the volume weighted average price, we're going to change the color of this one to purple, which are my preferred colors. Go Tigers. And my equities are green. I'm not saying equities in and of itself are green. Let me look. But my equities are green. Like my portfolio is green. The SPY's still red on the day for sure. Q still red on the day for sure as well. They're starting to look a little bit better. My portfolio is green on the day though, so not super green, but green nonetheless. Mostly Boeing helping that. If you guys remember, I bought the dip on Boeing at like 204 or something like that. I can't remember. Maybe it was 206 average price. It went up to almost 215s today. So we, that's mostly why we're green today, despite everything else. Again, let me do a poll here and ask the crowd what you guys think. Let me get this out of the way. There we go. Try to put this up. Put this up right here so it's not in the way as much. I'm going to just put 2 charts up. That's better. I don't know. I think we're going to... What do you guys think to do today? I'm pretty sure this is what's going to happen. We are going to pause rates. We're not going to raise rates. We're not going to cut rates. All right, so vote on the poll. We got the poll out live. What do you think the Fed's decision is going to be today? Pause, 25 basis point rate cut, or rate hike? Let me know what you guys think. It's almost certainly going to be a pause. All right, we're going to do a poll. All right, so we're going to do a poll. Do a poll on Twitter, done a poll on YouTube. We already got over 200 people here. Welcome, guys. Welcome. The Q push it up a little bit today. AMD moving up a little bit. Let me see if I can fix this. I always like it when there's no overlapped volumes. Let me just put 2 charts up. There we go. That's better. I think that's cleaner. But you can't quite see it. Let me raise this up a little bit. There we go. That's good. There we go. All right, we got AMD down here. Look at that. Put Tesla up maybe. They're all starting to rise. Tesla almost green on the day, so Tesla's doing a little bit better. Tesla up to 192s. And so that's nice to see. Let's see if it continues. We will see what he says about that today. Didn't they pause last time? Continuation of a pause. Yeah, I mean, that's almost certainly what we're going to get. If we look at the CME watch tool, you know, I see some people referencing it. If we pull this up here, you can see 96% of people expecting a pause. I mean, it's possible we cut rates. You know, this percentage has actually gone up a little bit from the last time we saw it. You know, again, this decision specifically being a 25 basis point cut. So 50 to 25, 500 to 525 would be a 25 basis point cut. That percentage has gone up a little bit since the last time we looked at it. I mean, still 96% roughly expecting a pause, a continued pause. And so again, I'm not sure what we're going to get. I'm pretty sure we're going to pause. I'm pretty sure, well, this is my guess is what's going to happen. I think the Fed, with the market so strong, I think what the Fed's going to do is the Fed is going to pause interest rates again, rate hikes, pause interest rate hikes, but take a hawkish or a more fearing inflation tone during the press conference at 2:30. That's my guess. Again, I'm going to say it again. I think Powell is going to take a hawkish tone, but pause interest rate hikes. That's what's probably going to happen, in my opinion. So I think he's going to. I think they're not going to raise rates. They're not going to cut rates. They're going to continue to pause interest rates. But when he does the press conference interview and Q&A, I think he's going to be a little bit more hawkish, meaning pushing for a more contracting, restrictive monetary policy, basically combating inflation more. Again, that's my guess, just because the market has been churning up. The labor market, we had the JOLTS report come out yesterday. That was very strong. And I know the Fed does not want a robust labor market right now because they want to hit their 2% inflation goal over time. And so in that regard, I think that's probably what's going to happen. Again, it's all a guess. You never really know for sure, but that's my guess. Hey, what's up, Jose? Thanks, bro. Yeah. I tend to agree with inflationary, hawkish tone, but another pause in rate hikes. Hi, what will happen to the dollar if the Fed pauses? We don't know. A pause in rate hikes is what's expected. You know, just to give you some understanding of economics and Fed procedure, every 6 weeks the Fed makes a decision in order to stimulate the economy or not through rate hikes and stuff like that. Now, when the Fed raises rates, they're doing so to combat inflation. They raise rates, it raises the federal funds rate, makes banking more expensive, and then banks in turn, their reaction to that is to raise interest rates to consumers. When interest rates are raised to consumers, people stop buying as much, and thus rate hikes have a trickling effect on inflation, meaning basically stopping people from buying as much. And in turn, businesses lower prices and inflation goes down to combat it, right? That's the procedure of it, and it happens every 6 weeks. And so when inflation is really bad, the Fed will take what's called a hawkish tone or a hawkish stance, meaning more rate hike potential. More fearing inflation is the understanding of it, right? If the Fed is hawkish, that means they're more so fearing inflation. If the Fed is dovish, they're more so worried on the other end of that spectrum towards like recession fears and stuff like that. But with the market ripping up and inflation still kind of sticky, the labor market's still very strong with the JOLTS report. Again, I think the Fed is going to be hawkish in their tone and their stance, but I think they're going to continue to pause rate hikes is my guess today. And then a couple weeks after today, we're going to have what's called the FOMC minutes report. We're going to live stream that thing in its entirety as well, like we always do. And that will break down why they chose to make the decision that they did today. And again, the procedure is at 2 p.m. they're going to announce the rate hike decision. It's almost certainly not going to be a rate hike or a cut. It's going to be a pause, most likely at least. And then 30 minutes later at 2:30, they are going to have the FOMC press conference with Jerome Powell and stuff like that to kind of talk about where they see the economy going. Some buzzwords that you want to pay attention to specifically are, number one, you want to listen to recession predictions, whether, we're still in that soft landing, we don't have to worry about a recession, what GDP predictions are, what the labor market fears are, what inflation expectations are, when we're going to hit the 2% inflation goal over time, what the FOMC's decisions are going to be further into 2024, what that looks like, and so forth and so on. And so again, a pause in rate hikes is going to be what's expected. It's a neutral outcome. That is what is overwhelmingly expected. It's almost certain that we're going to continue to pause rate hikes. And again, the big question for the FOMC meeting is, when does the Fed cut rates? When does the Fed decide to cut rates? I think most people are overwhelmingly expect May. For when rate hikes are really the most probable time for rate hikes is in May. But again, the Fed is very well known to change their plan, to change their decision making and all that good stuff. And so it could be earlier, it could be later. I think it's going to be earlier more so than later. As long as, PCE inflation was at 2.9% year over year last week. So we did have some inflation data to give you an understanding of the state of inflation in the U.S. right now. PCE inflation was at 2.9%. So, it's getting close to the 2% inflation goal over time. I can't remember what the last CPI report showed. But inflation's it certainly has gotten better from its peak, almost 2 years ago, when, quantitative easing and money printing caused just inflation to go rampant with everything with 2020 and all the craziness that came after that. Quantitative easing and money printing, which is stimulating the economy through money printing, caused kind of some problems with inflation. Inflation got up to almost 9%, a year plus ago. And inflation has gone down. It hasn't gone down. Let me clarify. It has slowed down a lot since then. Now, the natural state of inflation is that it continues to rise over time. We know this because if we look at how much a house cost 30 years ago, it's going to be noticeably cheaper than the same house today, which is going to be way more expensive. And so we know prices go up over time. And the job of the Fed is not necessarily to make prices decrease, but to slow that rise. Right, so when we say inflation is going down, that's actually what I meant, is that inflation is slowing down. It's not rising as fast because it's normal to expect a certain degree of inflation every year. The Fed's job in their rate hikes, and rate hikes do have a lagging effect. We've had a lot of rate hikes over the last few years. It does have a lagging effect here. So it takes time for those rate hikes to influence the economy of the U.S. And so another, thing is that we did raise rates really aggressively for years, or for a year and a half ago plus. Are those going to start to affect the banks in a more influential way? Like, is that going to mess with the banks more? And again, we don't know. That's where we're currently at right now. And yeah, again, just to restate what I think is going to happen, and you never really know, is that the FOMC Fed Chairman Jerome Powell is going to have a hawkish tone, but the Fed is going to choose to continue to pause rate hikes. So basically, I'm expecting 525 to 550, which is no change relative to the last meeting 6 weeks ago. All right. And this can cause a big influence over markets, a big move in markets. And so you do want to be wary of that big move. It can and will happen. Right now, most people are expecting a pause, which is what I would expect you guys to say. If you know what you're talking about, I would expect a pause. Maybe we shock the market, but it's very rare the Fed shocks the market. Most of the time, the Fed is going to stay very careful and balanced. That's normally what the Fed is going to choose to do, is stay balanced. And we'll see what happens. We'll see what happens. Tesla pushing up right now, testing the previous close, trying to go green on the day. Somebody asked me about gold specifically. Here's gold. Gold shot up to 2070s this morning. So gold has had a rampant rise ahead of the FOMC meeting. Ahead of it, the Q is now breaking over recent highs. Not quite highs of market hours, but it's close. The highs of market hours on the Q are 421.50s. Q is at 420.70, so it's approaching those levels. Tesla now, completely flat, testing almost green on the day again, starting to rise back up after most of the morning we had bearish red action. You can see Google still down pretty significantly on the day from earnings yesterday, even though the earnings were pretty good. I'm not sure why they're so negatively reacting to it. Microsoft also dropped earnings yesterday. They are red on the day, but a lot of these stocks, specifically these Magnificent Seven tech stocks, have had a crazy rise. Like, they have gone up so much relative to where they were at the beginning, 52 weeks ago. They've gone up a ton, all of them. Microsoft, Google, Apple, Amazon, like a lot of these are up a lot. And so these pullbacks were kind of a correction that a lot of people would argue was necessary, considering how much stuff was up, what their PE ratios were, and so forth. Gold pushing up. You can see it on the bottom right chart here. Gold at 2066, at least gold futures are right now. And yeah, let me know what your prediction is for gold. I don't know what it's going to do. Generally, gold follows the market. So if the market interprets something as bullish, it's pretty likely gold most likely will, but it's never 100%, and it's all just kind of, speculative here. The easiest way to question it is, are you bearish or bullish on today's FOMC decision and meeting? Let me know, are you bullish or bearish? Chat. I don't know what that is. House of Rising. Top is in for markets for a while. Correction incoming. Pullback not over. Yeah, maybe. Would JP Morgan stock go down if they pause? I'm not sure. I mean, it's possible they do. Again, understand a pause is technically a neutral reaction, a neutral decision. It is what's wildly, overwhelmingly expected is a pause. The main way we're going to get big volatility from this is what Jerome Powell says is going to have much more of an influence over the actual decision, and as long as the decision comes in with what's 95% plus expected, which is no increase or decrease. If the Fed chooses to do something outside of that expectation, so like as an example, if the Fed chooses to cut rates today, that is going to be a shock to the system in that way. And again, we don't really know how the market's going to react. We have had negative reactions to rate cuts in the future, or in history, but we've also had some positive reactions to rate cuts as well. But it will be, I'm sure it's going to be pretty volatile if that decision happens. But again, it's just so outside the probabilities that it's just not super likely. The market already acknowledged that the Fed will pause the rate hike this time, and I guess they'll begin to cut in May. Yeah, I mean, that's most likely what's going to happen. We don't know, though. Depends on quantitative tightening, sure. I reckon the Fed, because they will fight to retain their credibility above cut would risk their credibility, a hike would risk destroying. Yeah, I mean, I agree to a certain extent. The JOLTS number was not good for markets. Again, the JOLTS number showed much, much higher job numbers than they wanted, and the market did react negatively to the JOLTS numbers yesterday. Bullish, bearish, pause, I hope. Hope all is well. John was in a bad motorcycle, which had me out of the game and your channel for about a year. Oh, I'm sorry to hear that, brother. Hope you feel better, Michael. Glad you're back, bro. Hey, bro, actually, I thought there was no decision today, just commentary. No, today's the decision, Justin. So the way it works, right? So every FOMC meeting, there's going to be a press conference. I'm pretty sure, right? Let me make sure. Unless they... Yeah, there's a press conference today. Yeah. Yeah, there's a press conference. So again, this is the procedure that you're probably thinking of. So every 6 weeks, the Fed makes this decision. At 2 p.m., they announce the decision. And then at 2:30, they do a press conference, right? That's the first thing to understand. Now, in between those 6-week periods, this happens every 6 weeks. So it happens every month and a half. In between those, so 3 weeks after today, they're going to drop what's called the FOMC Fed Minutes Report, which is a detailed... it's a detailed breakdown of today's Fed decision and meeting. It gives foresight into why they made the rate decisions and what they might potentially do in the future and stuff like that. But that is where you'll have a report that drops at 2 p.m., but it's not the actual FOMC press conference like we have today. Today is the actual press conference with Jerome Powell coming out, right? So that's the difference. One's a meeting recap or meeting reaction, kind of a breakdown. Cliff notes of the meeting, essentially minutes is what they call it. Today's is the actual decision and the actual meeting with Jerome Powell and his stance and rate decision. So again, it happens every 6 weeks, and then weeks after today, you get the Fed minutes report, the FOMC minutes report. We live stream both of them, but today's the actual meeting for sure. You expect the dollar to go down? I really don't know what the dollar's going to do here. Yeah, I don't know in this situation what the dollar's going to do. You know. What will happen to gold? It depends on what the decision, and specifically it depends on what his stance is going to be. We don't really know how the market's going to react. You know, we could delve into what happened last time. So look, here's the NASDAQ. Let's look at gold last time. All right, so gold, they paused again last time. Right, the last time was December 15th, and so let me put up a 90-day chart. So the last one was right here. So you can see this volatility in gold. So the last time Powell, here's the last time. Wait, what's the time frame of a 15-minute chart? Trying to see what timing my chart have. All right, what time does it say today is? So gold. Okay, so this is Central Time. All right, so the meeting is at 1 o'clock. So the last meeting came in here. So the FOMC decision came out right here, but it didn't actually move gold that much, it seems. So again, here's gold. No, I'm sorry. Here's gold. The last FOMC decision was here. No. Yeah, right here. But it didn't really move. But the market did react negatively. You can see, though, afterwards, gold just kind of stayed flat. I'm pretty sure it's December 15th, right? But anyway, here was the last reaction. It was a negative reaction in gold from a pause. But it doesn't mean that's what we're going to get moving forward. You can see the timer right here, guys. Look at the timer right here. You can see the timer right above me. We got 37 minutes or so until the actual rate decision, and then the press conference is going to be 30 minutes after that. Was it December 13th? Let me look this up. My bad, dude. Let me see. All right, December. Okay, you're right. It was December 13th. I'm sorry. So this is just wildly wrong. Sorry. I thought I misunderstood. I thought it was, here's the decision right here. Nope, that's not it either. Where'd it go? Was this it? Let's see. All right, so here's the... I think the market ripped up, if I remember correctly, last time. I'm looking at gold here. Yeah, so here's the Fed decision right there. So the market loved it last time, it looks like. Yeah, so here's the Fed's decision right here. You can see how big, and this is a 15-minute chart. This is a huge increase. So the last time the market reacted very positively, specifically gold did. If we look at the SPY and we do the same thing with a 15-minute chart. Yeah, so if we look at the SPY, same thing here. You can see how strongly the market reacted last time. Here is the reaction in the SPY. So both markets, gold, the S&P, and you can kind of see how similar they are to each other. They move very similarly. The bottom chart here is the SPY, the S&P 500, basically. The top chart here is gold. Both of them had a very, very positive reaction. And I remember this. We were streaming the last meeting. So yeah, last time the Fed paused rate hikes, the market had a very strong upward response to it. And then during the actual press conference here, you could see the market ripped up even more. And same thing with gold. It doesn't mean that's what we're going to get now, though. It just doesn't mean necessarily that that's what we're going to get now. So, I mean, understand that. It doesn't mean we're going to go up. It doesn't mean the market's going to behave in the same way, because it really does vary, especially with, you can see, like, we've had pauses in rate hikes we had pauses in the federal funds rate for the last, like, I would say 3 meetings, if I remember correctly. I think it's been the last 3 meetings. I think the time before that we had a rate hike, a 25 basis point hike, a 25 basis point hike, if I remember the decisions correctly. Let me look. So December we had a pause, October we had a pause. Let me look in September. Okay, so yeah, in September we paused rate hikes as well. So let me see when the last rate hike was. Let's look in July. Okay, so the last rate hike was in July. They raised it 25 basis points. Since July, we've had a pause. We've paused rate hikes. We haven't done anything since July in terms of the federal funds rate. And so we've been pausing for months and months, and every reaction hasn't been necessarily positive. So what do you guys think? Do you think the market's going to react positively or negatively to a pause in rate hikes? Yeah, all good, Justin. How will it affect crypto? I really don't know. You know, we could look at crypto last time. Crypto is pumping up today as well. But, yeah, I mean, I could look at Bitcoin last time to see what happened. But it looks like Bitcoin ripped up with us as well during the FOMC decision last time. Yeah, Bitcoin reacted positively, I think. Yeah. So Bitcoin had a positive reaction on December 13th as well last year. So we'll see what happens, team. Hit that subscribe button. Hit the notification bell. I appreciate the love so much. We got about 600 people here live now. We got about 500 something votes. Most people are expecting a pause in rate hikes. 21% of people are expecting a 25 basis point cut. I mean, I don't think it's going to happen, but anything's possible, guys. Anything's possible. You can see gold is ripping up today. The S&P 500 is a little bit more sideways, I would say. Down slightly for sure. Definitely not sideways green. You know, we asked people on Twitter the same thing. 53% of people think he's going to take a dovish stance. 26% of people think he's going to take a hawkish stance. And 22% of people said, I don't know. Boeing, again, up a lot today. Equities, we are green. Rate cut will bring a rug pull the next day. Yeah, I don't think the market's going to react positively to a rate cut. But I also don't think we're going to cut rates today. So yeah, I just don't think the FOMC is going to. Yeah, I just don't think that they're going to cut rates today. If we do, I think we're going to react negatively to it, though. But you never really know. John, how could you be green? Boeing. You remember I bought Boeing a few days ago? I bought it at like 206s. Really what I did was I bought Boeing, took profit when it ripped up to like 215s, almost 220s, sold it at around there, waited for it to dip again, and then added more to it. And then it today ripped up to 214s, basically, almost 214. And so I took more profit today, and that has me nicely green, you know. So Boeing doing well. Definitely a pause. Inflationary risk still persists. War, yeah. If the rate pause, dollar index will go up or down. Could you answer me this question? Because I am in opening orders. Nobody knows, man. Nobody knows. That's like asking you what the lottery numbers are going to be tomorrow, brother. The dollar index is going to do inverse to what the market does. And so if you know what the dollar index is going to do, you know what the market does. If the dollar index goes down from this, the market's going to be ripping up, and vice versa. If the dollar index goes up, the market's going to be pushing down. And so that's basically like asking me, is the market going to go up or down from a pause? And again, I don't know. Nobody knows what the market's going to do. The market is very moody in that way. You know, and it's certainly not consistent in terms of reactions to this stuff. So what I do know is that we're most likely going to pause. The price action also depends on what Powell says during the press conference, like what Powell decides to say, what stance he takes, whether he's going to take optimistic, dovish. All right, guys. So I should have fixed it. I'm pretty sure we're back. We have a brand new mic, or we have a different mic. Hold on, guys. Bear with me, team. I know y'all can hear me. The mic quality is probably not super good. We're plugging in our other mic and it should work fairly well. I don't know what's going on with this mic. Yeah, I know y'all can hear me now. Give me 1 second. I'll answer that question. For whatever reason. Yeah, it's just super weird. I mean, we got this working. Hold on 1 second. I know this is the camera mic. So the mic you guys can hear right now is the camera. So I'll be right back here, team. I'll be right back. I know how to fix it, I think. All right, so again, can y'all hear me? Bear with me, pun intended for sure. The FOMC decision is at 2 p.m. Eastern Standard Time, at 2 p.m. Eastern Standard Time, guys. So y'all bear with me. We're getting everything working. And again, right now, I know the audio sucks. Loud and clear. Okay, good. Yeah, as long as y'all can hear me, we're going to get it done. So weird, dude. I might have to... Top 3 audios in the world right now for sure. Let me try this new mic. I got a new... I think the problem is most likely with the cord of the mic that I'm specifically using. So let's put a new cord in here. That must be the problem. Alright, guys. Bear with me. We got multiple mics here. Multiple mics. The show must go on, as they say. There we go. All right, guys, we got 700 people here live. 700 people here. We got 2 of the same mics right here. Can you see this? There we go. Test, 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 test. Okay, we know which one's working now. We'll get this one out the way. All right, guys, so we are back. Let me know how the volume sounds. It should be pretty solid. It should be pretty solid. You know, it's actually going to be a little bit better than it was. Am I tripping, or does this guy look like Ryan Felipe? Bro, you know, you're not the first person to tell me that. I've heard a lot of things over time, though. Like, I've heard a lot of things over time. I've heard some good ones and bad ones, you know. Yeah, definitely got more mics than Powell. Hey, what's up, Bruce? Yeah, I didn't get to go to jiu-jitsu today, bro. I wish I did, but this show must go on, sir. All right, guys. Hey, we got 25 minutes. Yeah, hit the like button on the stream. Hit the notification bell. Yeah, I've gotten Paul Felder, the Irish Dragon. I've gotten Ryan Felipe. The worst one is probably Forrest Griffin. I don't know why everybody relates me to MMA fighters. I'm a big MMA fan, and I train like BJJ, but like Forrest Griffin, I took that personal. Okay, I took that personal here. Like Forrest Griffin, guys, come on now, man. You know, the decision is at 2 p.m. Eastern Standard Time. 2 p.m. Eastern Standard Time is when the Fed's decision is going to be. We don't know what their decision is going to be. Dude, how dare you? Forrest Griffin. Y'all want to see Forrest Griffin? Let me show you guys. For those that don't understand. For those that don't understand, let me show you guys Forrest Griffin. I don't know. I guess I can kind of see it. I guess I can kind of see Forrest Griffin, but how dare you? Okay. I'm okay with Ryan Felipe. I got Paul Felder a lot too. I'm okay with him, I guess. Yeah, just don't get cauliflower ear. I'll be all right. Your voice sounds like an MMA fighter. I think this FOMC meeting will be one of the most important meetings of the year based on what he says specifically when rate cuts will start. I think it's important. I think when he announces rate cuts is going to be the biggest one most likely, but you never really know. Yeah, Forrest Griffin would beat me up, dude. I don't know. His chin's a little, you know, I'm not trying to. But his chin's questionable at this age. I can't judge. Who knows if my chin's even good. I haven't been punched in years. We need rate cuts now. I don't think the market wants rate cuts. How will the market react if we announce a rate cut today, guys? That's a good question. How will the market react to a rate cut today? Genuine question. Good, bad? Good? Yes, no? Top 3 unique faces in the world right now for sure. Will the market like a rate cut? I don't think so. I think the market's going to dump. He's 240 pounds. I'd guillotine him. You know what I mean? I got one of the top 3 guillotines of all time. I know. I'm trolling, you know. Forrest Griffin would ragdoll me, bro. On a serious note. NASDAQ's been pushing up a little bit today. The SPY is trying to make moves. SPY's not really trying to make moves. The NASDAQ is more so trying to make moves. Tesla's coming back up as well here. Tesla up to almost 192. It's technically green on the day right now. The Guillotine Queen. That's a new nickname, bro. Top 3 nicknames of all time. You know. Means the job report Friday. Yeah, this Friday we have unemployment and non-farm payrolls, NFP. It's going to be a big day. Tomorrow we have Apple, Amazon, Meta earnings, and jobless claims numbers. A lot of stuff going on this week, guys. Today's probably the biggest day, though, specifically with this rate decision. Although tomorrow's earnings, Friday's unemployment and payroll numbers will be super relevant as well. Forrest Gump, dude. The GOAT. Powell might know that a cut will drop market, so he might cut, but I think pause. I don't know. He tries to do a good job at balancing things, you know. So, like, Powell really does do a good job of balance. Like, he tries to make sure there's balance. And so, that's one of the reasons I don't think we're going to cut today, but you never really know. I mean, it's wildly expected. Again, if we look at the CME watch tool, you know, if you look at the CME watch tool, it's just pretty probable that we're going to cut, or we're gonna pause rate hikes today. It's pretty probable that we're gonna pause again today. Very unlikely. This has actually gone up, though. I said this earlier. This has actually gone up versus the last time I looked at it. This is still 96+%, though, so it's still, you know, in probability terms, it's very, very probable that we do not cut rates today, that we pause again. But again, it's not 0% chance. You know, there's a 4+% chance that we're gonna cut rates, and so maybe it happens again. I don't think it's a good move. I think if we cut rates today, the market's dumping down. You know, but again, who knows? We'll see. It'll be a fun time, and again, we'll see what happens. Just got off. What did he say, please? Nothing. Jonathan says, what's the guillotine move? I used to wrestle, but don't know that move. Honestly, ironically, wrestlers are the ones I catch with it the most, bro, because wrestlers are used to dumping in behind people's arms, and the guillotine is a front headlock. So it's not a bulldog choke where you're kind of like this, you know, it's more of a grab, sit up. You get your hand like right here. The way to escape it is to pass to side control on the other side. Or to use your head as a post off the ground, post with your head off the ground. There's a lot of ways to get around it, but the way I usually catch people with it, though, is I guillotine people, and then when they try to escape, I follow them into mount, and then I get a mounted guillotine on them and get the tap that way. Is usually how I catch people. Again, though, I'm still a white belt. I'm really not that good. So yeah, I can't really tap anybody outside of white belts with it, you know. Keep that head tucked. Yeah. How will the market react to a pause? Last time, you know, in December, we paused rate hikes. And again, the market ripped up. So again, last December, in December of 2023, gold had a very positive reaction to the FOMC decision. The market itself had a very positive reaction to the FOMC decision. And so, yeah, we'll see what happens. I don't know if you should buy Bitcoin or not. This is not a, I don't drink beer. This is a stevia cola. This is a sugar-free Coca-Cola. All right, don't judge me here, all right? I need some caffeine. Coffee's too much. I'll be wired for the rest of the day. And I'm trying to I'm getting old. I'm trying to limit my sugar intake. So top 3 oldest people in the world. But the NASDAQ bouncing a little bit at the volume-weighted average price, up to almost 13.5K. Still moving up. Boeing still at 212s. You know, honestly, the dynamic of every time I get a good swing trade, everybody tells me not to do it. I bought Boeing a couple days ago at like 206. Everybody told me no. They said, no, don't buy it. It's got bad news or whatever. That's why I'm buying it. I'm buying it because it's dropping significant percentages in a short period of time. And I consider it an overreaction. Boeing dipped to 200, 199s. Now it's back up to almost 214s today. I was able to take a majority of my profit off of Boeing. I'm still holding a third of the position I had today, but I took profit on it. It's helping me be green today in a day that's otherwise pretty red market in the market. So again, it's just kind of a lesson. If you're swing trading or investing, it only works for blue chip companies, like large cap blue chip companies. It can't be penny stocks. They're terrible companies most of the time. But if you can wait for a decent overreaction from a catalyst, there's a lot of opportunity in my opinion. And even if you're wrong, most of the time you can kind of just keep holding and waiting, and most of them are eventually going to, come back up and close green for you if you're patient enough. But again, most of the time short term, I get pretty nice bounces quickly. How big of an account are you trading? This is a $60,000 account. I got about $250,000 in buying power on it. It's a TOS account too. It's a Thinkorswim account. I also trade futures. And so you can see the futures on the left side. Why not just buy the SPY and forget about those companies hurting your wallet? I mean, I do. I'm holding the SPY as well. I've always told people my perfect portfolio, like for me, again, I can't say it's the perfect portfolio for you. Remember, guys, okay, remember, I am terrible at this stuff. and have no idea what I'm talking about, I'm wildly wrong about anything and everything. Okay? Understand this rule. Some of the trades we're doing are in funded account programs and combines trying to get funded. We're already funded in our TOS account. Like, we got a bunch of different accounts that we play with. We can't guarantee anything. And again, just remember the overarching point of today is that we have no idea what we're talking about. All right. But yeah, just got to put my disclaimer out there. But anyways, the NASDAQ's mostly consolidating around the volume weighted average price. We'll see if it holds. But anyways, what I was trying to say is that if I had a perfect investment account, it would be the S&P 500, maybe the SPY or whatever vehicle for the S&P 500 you want. It would be that, the NASDAQ, gold, silver, either real estate investment trust or just simple real estate and bonds. And I would buy that and I would sit on that long term. And I'd probably also cherry pick a few of the Magnificent Seven stocks to buy and sit on to get a little bit larger weight of my portfolio with them. Because I think over time, they're obviously going to make money. Maybe they contract, maybe they correct, maybe they come back down. But, you know, I think those are the ones that have the biggest bang for your buck in terms of long-term potential. Not all of them, though. You're going to have some that fail. But anyways, again, guys, we got 15 minutes until the FOMC decision, 15 minutes. What are the good phrases and the bad phrases? I don't know if there's good or bad. I would listen to what he says regarding a recession, what he says the plan is for rate cuts, like what date he plans on cutting rates. If it's earlier than anticipated, it might cause negative reactions in markets, even though it's more optimism for inflation, you know, more dovish. A rate cut could signal bearish action. And so if he says they're going to cut rates earlier, more earlier than expected, that might not necessarily be a good sign. Inflation expectations as well, when he thinks we're going to hit the 2% inflation goal, whether it's next year or the year after or whenever. Those are all things you want to pay attention to. And again, like I said, what the tone is of his interview, of his conference. Does he think the economy's in a good place? What the job market looks like right now. Again, the PCE inflation data came out last week at 2.9%. And so in that regard, that's a very relevant thing. Inflation's at roughly 2.9%. It's not bad. Their goal is to hit 2% over time. And so again, what that means, what the state of inflation looks like. And with that in mind, what the jobs market looks like. The Fed has historically feared the jobs market recently because it's too robust, it's too strong, too many people are working and spending money, and inflation's going up. It's all mostly from, again, the quantitative easing, money printing that happened after the pandemic. You know, we had that happen. We had the Fed print money, put out stimulus checks, quantitative easing, and then prices skyrocketed to almost 9% inflation a couple years ago. And now it's finally starting to get back down. But again, it's at 2.9%, 3% roughly right now. But the Fed's goal is 2%. And they said one of the obstacles to that was the labor market. And with the JOLTS report coming out yesterday, that might be an obstacle to inflation expectations, or what the inflation goals, I should say. And so that's certainly something you want to listen to regarding Powell and jobs, rate cut decisions and stuff like that. Like, that's what you want to pay attention to. Remember, the FOMC decision is simply the Fed trying to push down the market with inflation if they raise rates, right? If inflation is really bad, they raise rates and take what's called a hawkish stance, a more restrictive monetary policy by pushing down prices through rate hikes. Again, they raise the federal funds rate, makes banking more expensive. Banks raise interest rates to consumers. People stop buying because of it, and then prices go down because people stop buying. That's how it works. And so when inflation's bad, they raise rates. When inflation is good and they're more so fearing a recession, they could potentially cut rates, but it will signal more inflation fears if they start cutting rates too early. So it's a really nuanced thing. The wildly expected number today is a pause. We're almost certainly not going to raise rates. We could cut rates. Again, we've got about a 4% chance of a rate cut, but I don't think it's super probable or super likely. And most other people don't as well. And again, we still got 12 minutes or so. 12 minutes. Get your last minute predictions out in chat. Yeah, very low chance for a hike. We're almost certainly not going to hike rates today. I mean, anything could happen, but it's just probably not going to happen. Gold will tank. It depends on what the decision is and what Powell says, but maybe. I don't know. Money prints are going burr. Maybe. All right, guys, remember, we got the FOMC decision. NASDAQ pushing up a little bit from the volume-weighted average price. You know, we opened up really red today. Yesterday, we had a lot of volatility from the JOLTS report. Again, if you look at the market yesterday, we mostly had a sideways day in the S&P. The NASDAQ specifically yesterday was, let me look at it. The NASDAQ was red. The S&P was flat, mostly from job numbers coming in too high. So the JOLTS report, the job openings report, made the market dip. And again, the reason the market dipped on JOLTS was because JOLTS came in over 9 million. They expected 8 point something million. It came in over 9 million. That means more economic growth, more jobs. And in that regard, all with the inflation lens in mind, that's bad. More people working, more people spending. Spending causes inflation to go up. It's bad right now, right? So it keeps us from hitting the inflation goal target. And that's how the market's been for the last year plus, I would say. Pretty much fearing the job market. It does not want higher payroll numbers. It does not want more job openings. It does not necessarily want economic growth, except for GDP. But again, it's really nuanced. Will we cut rates today? Again, vote on the poll. Let me know how you feel. We still got 10 minutes before this report drops. 10 minutes. Yeah, we're going to stream the entire FOMC meeting. I'm not going to say you can read it right here just to weatherman it. But in this general vicinity, right there, it might say we're going to stream the entire, FOMC conference. I think nobody sees a raise coming, which to me, the more likely the contrarian move would. Yeah, but you got to understand the history of the Fed decisions, Peter. Peter says it's contrarian move. Again, true, it definitely is a contrarian move, but the Fed is more so pushing balance. They very rarely shock the market and do something outside of expectations. And if they do something outside of expectations today, I think it's going to be a rate cut. But I don't think that's going to happen either. I think they're going to pause, and then what's going to matter the most is what Powell says during the interview process, which I think he's going to personally take a hawkish stance, a more restrictive stance, because jobs came in high. PCE data wasn't necessarily great, and so still fearing jobs, inflation. I think he's going to take a hawkish stance, but I think we're going to pause, which is what's expected today. Hey, thank you, Traditional. I appreciate you, brother. Thank you, man. Welcome, dude. Again, will we cut rates today? Guys, let me know. Eight minutes, guys. We're about 8.5 minutes, but yeah. We got about 2,000 people here live. Again, hit that subscribe button, hit the notification bell. I appreciate it. We're also going to throw this in sub-only mode. So if you haven't already, hit the subscribe button and listen. I know you're sitting at home and you're like, man, dude, this dude John's kind of sketchy. Why should I subscribe to him? I'm telling you, you should, because we give everything away for free. I'm not a day trading guru. I might suck at day trading. I don't guarantee anything. I don't sell a course. I don't sell a service. I don't claim to be an expert or even a good trader. We post fast, economic, reliable data for free every single day, every single week right here. We don't charge for anything. And so if you want a one-stop shop that's going to cover all the earnings, the full earnings calls, all the economic data, FOMC press conferences, Jerome Powell, jobless claims numbers, unemployment, payroll numbers, all that good stuff. We stream it all. We're a reliable place. Hit the subscribe button. Do it now. Now I got to breathe a little bit. What's your bias? My bias is a pause decision, which is what's expected, and a hawkish tone for Powell. That's what I think. I think hawkish makes sense. I think Powell's going to fear jobs, and I think the JOLTS report came in high. Jobs numbers have been a little bit higher recently, and so I think he's going to be fearing the labor market and inflation, and he's going to continue to pause rate hikes, but he's going to be a little bit more restrictive policy-wise, fearing inflation. That's my guess. Again, I might be wildly wrong. Maybe he cuts rates and takes a dovish stance. I don't know, but I don't think it's super probable. Again, we just hit we put it in sub-only mode. Everybody announce yourself. Show us you're subscribed. We appreciate it. We still got 7 minutes here, guys. 7 minutes. That's why I come here. Other channels, they want me to pay them so I can watch them day trade. Yeah, I feel you. Pause today, but may sound hawkish due to growth in jobs and strong economics. They don't like, yeah. That's why I come here. Other channels, they want me to pay them. Yeah, I mean, I feel you, man. Where everything's free. I could very easily, I told people this earlier, I could very easily take the day trading guru route and tell people I'm some pro day trader. I live in a very nice house. I'm not trying to brag, but if I wanted to use my current house for marketing purposes and act like I'm some day trading millionaire and sell you guys a course for thousands of dollars, I could, and I would make millions doing it. I'd rather just make less and sleep good at night and just not have that pressure and just tell people that I'm not an expert, you know? And so again, subscribe if you haven't yet. We appreciate it. Job numbers are up. Yeah, job numbers come out Friday. Unemployment job numbers and payroll job numbers. Again, I think it's going to be something in which if we get higher payroll numbers, the market's not going to love it. I think if we get high payroll numbers, the market's going to dump, is what I personally think. Let me know what you guys think. But again, the Fed decision today might influence all of that. And then tomorrow, again, we've got Apple, Amazon, and Meta earnings going live tomorrow afternoon. We're going to stream those as well. And I mean, listen, honest John, I am honest. But again, let me be real with you guys. I'm doing this to make money for sure. You know, again, you got some people that are like, oh, I'm doing it out of the kindness of my heart. You know, look at me build hospitals overseas, blah, 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 blah. Bro, everybody's doing this to make money. Anybody that claims to be sitting here for hours out of the kindness of their heart is so full of it. I'd rather just be real. Of course, I'm here to make money. You can't really judge me for it. I'm providing a valuable service, in my opinion. I'm giving people economic reports reliably for free. And so it doesn't cost anything. And so, hey, hit the subscribe button. We got 5 minutes here, guys. 5 minutes. Also, you want to make sure you hit the live button next to the play button. It'll make sure you're fully caught up on stream so you get the decision as soon as it drops. Well, yeah, I mean, that's not really... I can't really get mad at a YouTuber if they earn more from courses. You can make millions but are not. I mean, I'm not going to be specific. It's going to cause too many haters. What I'm saying is if I wanted to sell a course and charge a ridiculous premium for it and exaggerate everything to make millions of dollars, I could, is what I'm trying to say. I'd rather not, though, you know. No, everybody's asking me what I'm drinking. I'm drinking a sugar-free cola called Zevia Cola. Okay, sugar-free. It's stevia related. It's got caffeine in it. It can be hard to find the meats, calls, etc. Thanks, John, for having it all here. Hey, no worries, man. All right, guys. Hey, we got 4 minutes here, team. 4 minutes. How fast are you going to give us the report? I'm going to give it quick. I don't know what the market's going to do, what the market's going to react to, or anything like that. But we will have the decision very quickly. Here, just make sure you're, again, guys, you want to make sure your live button looks like this. You want to make sure your live button, let me get out of SoFi stuff. You want to make sure your live button is red like this. You want to make sure your live button next to the play button has a red dot next to it. You could also put it in fast forward mode. It's going to help you get a little bit more, a little bit quicker updates. If the rate paused, what happens to the market? We don't know. Last time in December, we paused and the market flew up, but it's not always consistent with previous outcomes, right? Like December, we might have ripped up on a pause. Time before that, we might have dumped down. We don't really know what's going to matter more. A pause is a neutral reaction, technically. Like a pause is a neutral outcome. If we announce a pause, that's neutral. That's not good. That's not bad. That's neutral. It's what's expected. 95% plus expected. And so that is a neutral outcome. Again, if we cut rates, that's not super expected. That'll shock the market. I think the market will drop. But what's going to happen if we come in as expected, I'm not sure. Hey, thank you, Andre. Again, hit the subscribe button. We broke 123,000 subs yesterday. Or today, I think this morning, actually. And again, guys, look. Here is the site. All right, we're going to put the site up. So, again, every 6 weeks, the Fed makes this decision. All right, so every 6 weeks, the Fed makes this decision. Today's going to be 2024, and so the January decision is going to show up right here. Right here is where it's going to show up. Again, we're going to break it down in detail, what the outcome is, what the decision is. We got 2 minutes here, team. 2 minutes. Be ready. All right, guys, you ready? All right, guys, 2 minutes. Fang are dropping on earnings. Yeah, a lot of big drops from earnings yesterday is what happened. Like yesterday, the market absolutely dumped on Microsoft, AMD, and Google earnings. We were streaming all of them except for AMD, but market fell pretty quickly yesterday for sure. All right, team, we got a minute and a half. Here's the NASDAQ on the left side. We have the SPY and gold up on the right side here. We'll put a 1 minute chart up so we can see these moves a little bit shorter term. Here we go. A minute and a half, guys. A little bit under a minute and a half. Again, make sure you hit the live button next to the play button. Make sure you're fully caught up on stream. Data's about to go live right now. You guys ready? We got 1 minute, team. 1 minute. Yeah, I mean, most of the time the crypto market follows the market in general, right? So, like, most of the time the crypto market follows the market in general. Get ready, guys. Get ready. Report's about to drop. Let me get everything ready so I can really get the details of the report live as soon as it happens. All right, guys, 30 seconds, a little bit over 30 seconds. Time is about to start, guys. About 20 seconds. Be ready here, team. Be ready. What will the market do? Get your last minute predictions out in chat. Last minute predictions. Again, 15 seconds. 15 seconds. All right, here we go, guys. 10 seconds. Really, we got about 5 seconds left, even though the timer just went off. 5 seconds. Let's watch the market. Here's the NASDAQ, and here we go. Here's the report. Market has pushed up a little bit from this report, waiting for the decision. Market's now down a little bit, waiting for the decision number. I'm pretty sure it's going to be a pause. No changes in rates. 550 is what happened. No changes in rates. Another pause. Again, another rate pause. That's what we told you guys would most likely happen, was a pause, and that's what we got. Committee decided to maintain the target range from the federal funds rate at 5.25% to 5.5%, pausing rate hikes. Again, you can see this data right here. We'll put this data up, and in support of these goals, pause on rate hikes. Again, FOMC pauses rate hikes. They did not choose to do anything. It continues to pause rate hikes. Put this up on screen right here. We got the actual press conference live. Again, we're going to go ahead and read this. Recent indicators suggest the economic activity has been expanding at a solid pace. Job gains have moderated since early last year, but remain strong. And the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. And the committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. The committee judges that the risks to achieving its employment and inflation goals are moving into better balance, and the economic outlook is uncertain, and the committee remains attentive to inflation risks. In support of this, they are continuing to pause rate hike decisions from this. And again, we're going to do the actual press conference later. But again, another pause in rate hikes. The market has not reacted positively to this so far. We have so far reacted in a negative way. And remember, guys, we are going to be streaming the entire FOMC press conference. The entire FOMC press conference is going to be streamed live right here. So be ready, stick around. The entire FOMC press conference is going to be streamed live here, like we always do here, guys. So stick around. Let's do this. We're going to go ahead and get ready. Market is not reacting positively to this, guys. Look at the dump. Look at the dump. Again, Q down. Gold is down. The SPY is down. Let's see, Bitcoin. Bitcoin's down slightly. Down slightly. And so, we'll see what happens here, guys. But there's the market right now. We got about 5,000 people here live here, team. About 5,000 people here live. So don't forget to subscribe. Help me hit 124K. If you haven't already, help me hit 124K. Currently, we are at 123.3 thousand. We got thousands and thousands of people here. I'm not going to pressure you. Subscribe or I'll hate you forever. Do it now. Again, the federal funds rate has been paused for like the 4th time in a row. The 4th time in a row. What this means, and again, we're going to stream the entire press conference. We'll put a timer up for this press conference. We're going to stream the entire thing live in about 27 and a half minutes. 27 and a half minutes. Market is so far is reacting negatively to this. So far is reacting negatively. Again, what this means is that the Fed is not raising rates. It's kind of a neutral situation, of course. The Fed is not raising rates. When the Fed raises rates, it raises the federal funds rate. Banks raise interest rates to consumers because they lose margins when the federal funds rate is raised. With the federal funds rate continuing to pause from the Fed, it's neutral outcome. What's going to matter more so than this decision, again, we told you guys it would probably be this. What's going to matter more so than this decision is going to be what Powell says during the FOMC meeting. What Powell says during the actual meeting, and we're going to stream the entire thing live at 2:30. So stick around. All right, so again, full streamed at press conference. We're going to put this up just so people understand. Full press conference streamed at 2:30. Also, guys, market's starting to bounce up a little bit. So again, we've been streaming every day. Since you haven't already, check out Top Step. Top Step is a funded account program in futures. If you want to day trade, you can either put up a cash account in stocks and probably lose thousands of dollars trying to day trade penny stocks or day trade large cap stocks. You're going to need a ton of money. It's going to be very difficult, and most day traders lose. The futures market, there's no PDT restrictions. I can day trade the NASDAQ, which is what you see on the left side. I can day trade gold. I can day trade currencies. Patterns are very similar to blue chip stock patterns in day trading. There's just no PDT rule. Funded account programs are allowed, and it makes perfect sense for new traders because, again, if you think about it, most day traders lose. So you can put up thousands yourself and risk that, or you can try a funded account program. Top Step's the most legit one in the world. They give you a demo. They test your skill. If you could pass the test on the demo, the base one, they give you a 50K demo. You got to hit 3K in profit without losing 2K. If you could pass that test, they fund you $50,000 with a 90% split. And so once you're funded, you're keeping most of your profit anyway. But if you lose, you're going to lose much less than another trader losing their account. And so it makes perfect sense. Limited risk. It teaches you how to trade. There's free funding coaches. Top Step has been around for over a decade. They are a sponsor of mine. I'm super biased in their favor because they pay me money. But if you want to check them out, definitely a great way to help support the channel. There's the link in chat right there. I'll put it up on screen. Market's starting to bounce back a little bit here. Why are big tech stocks declining even after good performance matching the expectations of investors? To put it bluntly, the market's just not that easy, brother. There's a lot of nuance behind it. Specifically, like if it was as easy as sitting around waiting for a company to post good earnings, right? Waiting for good EPS, good revenue, good guidance, and clicking buy, everybody would be rich, bro. I would just sit around for earnings and wait for a company to have good earnings and buy it and then sit, right? It's just not that easy. I wish it was. It's just not that easy. There's tons of nuance with regards to prices. Like the outcome of those earnings was baked in over the last month. Traders have gotten in understanding that we might beat expectations this month, so forth and so on. Banks know a lot. A lot of big money is baking in earlier than the specific earnings released to these outcomes, right? That's the thing to understand, is that it's not always good earnings, market goes up. Good earnings, stocks go up. I wish it did. It would just be too easy to make money, bro. You know, Fed rate decision, bullish or bearish? It's neutral. It's what was expected. Again, we're completely flat because this outcome was neutral. What's going to matter more than any of this, team, remember, is what Powell says during the press conference. That's going to matter more than all of this. I read Wall Street is expecting good earnings. That's why tech dropped. Yeah, I mean, most of the earnings were baked in already. Apple started to push up, but most stocks and blue chips have dropped from the FOMC meeting, I would say. Not all of them, though. What's the outcome of the meeting? The meeting hasn't started yet. The meeting is in about 23 minutes. So the meeting is in about 23 minutes. The outcome hasn't started yet. Or the meeting hasn't started yet. And we're going to stream the entire thing live. You won't have to go anywhere, bro. We'll stream the entire thing live. Again, don't forget to subscribe as well if you haven't yet. You know, we got 123.5K. If we get 500 more subs, and we got 4,500 people here live. If we get 45 more subs, 450 more subs, we break 124K. That'd be 1,000 subs in one day. Do it now, guys. Do it now. Fed rate impact on commodities. Silver, well, gold is reacting negatively. But again, one thing I always try to tell people is on a macro level, gold and precious metals mostly follow the broad markets. Like here's the NASDAQ 100 on the left, and then here's gold on the top right. And then here's the SPY on the bottom right. You'll notice something is that they all look very, very similar to each other. Like they're all doing the same thing because on a macro level, they follow each other. Micro level, sometimes there's going to be shorter term deviations. Not right now. Right now, macro and micro are following each other. But longer term, you know, they're going to follow each other for the most part. Same thing with like mortgages as well. The dollar index, we can take a look at that. Dollar index currently, again, moving up with the market moving down. Usually the Dixie is inversely correlated with markets. And so again, you can kind of see downward move, consolidation on gold. In the dollar index, you got an upward move and consolidation on the Dixie. Sounds like no rate cut for March. We can see how the probabilities have been affected by this, guys. So let's look at the probabilities and how they're ultimately affected by this rate decision here. So again, market's mostly down. Market's mostly down. If I look at the FOMC potential decisions here moving forward. So again, if we look at the potential decisions moving forward, here is today's decision, which is January. Let's scroll up and look at March. So for now, most people are actually expecting a rate cut in March. So again, in March, most people are expecting a cut again, which is interesting. I think earlier today, most people were expecting a pause again. Here's a pause. Here's a rate cut of 25 basis points. Here's a 50 basis points rate cut. And so one interesting thing is that now after today's decision, most people are expecting a cut in March. So the next FOMC meeting will most likely be a cut according to the CME Watch Tool probabilities. And again, we'll see. Nothing's set in stone. Again, we still got 20 minutes, guys. 20 minutes before the FOMC rate decision, or before the FOMC press conference. So stick around. We will be live streaming this again, so be ready. And again, guys, remember. Again, I'm gonna put this up again just because it's absolutely true. Remember, I am terrible at this stuff and have no idea what I'm talking about. Understand CFTC Rule 4.41. I can't guarantee anything. We trade our TOS account, our Thinkorswim TD Ameritrade account's got like 60,000 plus in it. But we also trade like funded account programs. We try to get funded in some of the accounts. Some of them we're actually funded in 2 of them. And so we trade a bunch of different stuff. Understand we can't guarantee anything because remember, the overarching point is we have no idea what we're talking about. All right, guys, market's slowly climbing up a little bit, but we're very flat from this report. Again, the whole market's essentially waiting for Powell. Hey, thanks so much to Ari for becoming a member, brother. Thanks so much, man. I appreciate you becoming a member. Members team, again, we don't sell a course, we don't sell a service, we don't have any paywalls behind content, and so you don't get anything super special except for these coveted beardless John emojis. Look, there's beardless John. Here's my wife Carol. Here's the greatest German Shepherd ever, Rosie. And so yeah, check it out, guys. Become a member if you want. Will the Fed pump money again into the economy? I'm not sure. Quantitative easing, I don't know. Maybe. In trading, could you break this abbreviation? Pattern day trading rule. So the PDT rule specifically states if you want to day trade stocks, you have to have over $25,000 in a margin account to do so freely. It's the most ridiculous rule in the world. The reason it's ridiculous is because almost all new day traders lose money. And so if you force a new day trader that wants to trade with flexibility to trade with a $25,000 account for his first account, you're essentially forcing him to lose $10,000+ because almost every new day trader loses their first few accounts. It's one of the reasons funded account programs make so much sense is because it gets you around the PDT rule. There's no PDT rule in futures. You can practice trying to get funded, and if you lose, it's not the end of the world. But if you're good enough to get funded, again, 50 to 150K in funding, and you're keeping 90% once you're funded anyway, and so you're keeping most of your money anyway once you're funded. And so it's just the best of both worlds in my opinion. But again, they're a sponsor of mine. They pay me money. I'm biased, but I genuinely think it's good for traders. Again, if you want to check it out, here's the link. You could trade a cash account, problem solved. Not necessarily. With a cash account, you can only go long, and you have to wait for your funds to settle every day, right? So what that means is that if I buy 1,000 shares of a $1 stock with a cash account, I have to wait 2 days with the T2 rule to get that $1,000 put back into my account. I can also only go long, and so you're just severely restricted with the cash account. You can't do so flexibly. What is the effect on gold? Gold has initially reacted negatively, but again, this is a flat report. The whole market's starting to push up. Gold is starting to move up. The NASDAQ is starting to creep up a little bit as well. So initially, we've had in macro markets a negative short-term reaction to the FOMC decision, which was a pause as expected. But short-term after that, we're starting to move up a little bit in gold, in the NASDAQ. And we can also look at, like, what's another symbol you guys want to see? Bitcoin. Bitcoin currently moving down a little bit, but Bitcoin's had a pretty good day. It's still a little flat or slightly red on the day, but it's rebounded a lot relative to where it was. The number of times I could have saved money but lost due to the PDT. Yeah, the PDT rule is one of the most ridiculous rules in trading. It really is. They say it's to help traders. It's really to give your banks longer term interest. It gives banks longer to hold your money and earn interest on it is what it really does. And again, it's absolutely ridiculous, man. Forcing a new trader that wants to be able to day trade without restriction to trade with 25 grand. Whose idea was this? It's the dumbest rule ever. Hey, thank you so much, Joe. I appreciate you, brother. Thank you, man. TLT, what is that, 20-year bonds, right? TLT is down. What's the 10-year bonds at right now? Yeah, they're at 3.97%. So they're still, so 10-year yields are still under 4%. If you don't know what bonds are, guys, just to put this into perspective, thanks so much for the donation, though, brother, by the way. So again, a lot of the time on a micro level, equities, and bonds are going to move inversely to each other. Why? Because they're competitive with each other. The S&P 500 are just investing in equities. On average, is going to give you around 10% if you invest in the S&P 500 index fund or something like that, right? It's going to give you on average 10%, and that includes crash statistics, which means that on good years, it's going to move up much more than 10%. Cough, cough, last year, 24%. But it's not guaranteed, right? So you could have crashes anytime, you could have corrections anytime. Now, when you compare that to bonds, which are lower yield, again, the 10-year right now giving you about 3.97%, and the bonds are just loaning the U.S. government money. Treasury bonds are just loaning the U.S. government money with guaranteed returns. So right now you get about 4%. If you loan the U.S. government in 10-year bonds $100,000, every year they're going to pay you 4%. So they're going to give you $4K a year in interest payments, and then at the end of that 10-year period, you're going to get your $100K back, right? So you're going to make over 10 years about 40% in bonds. But it's guaranteed by the U.S. government. Now, again, so people are going to, at certain market periods, some people are going to buy bonds. At other market periods, some people are going to buy equities, right? And so they're competitive with each other. So when equities go down, bonds prices go up a lot of the time. And they're really nuanced, in terms of like banks buying bonds and stuff like that. So it varies a lot. But yeah. What about crypto, dude? I'm looking at Bitcoin. Bitcoin is... Bitcoin down to 43.6K. All right, team, we got 15 minutes here, team. 15 minutes before the FOMC decision. 15 minutes. Let's see what happens. 15 minutes before the FOMC decision. Again, we got about 4,000 people still here live. Remember, we're going to cover the entire meeting. We'll put this up a little bit clearer. All right, so we're going to put this up on the stream. Remember, we will stream the full FOMC meeting with Powell at 2:30 in 14 minutes. Here, guys, 14 minutes. Will crude go up? I don't know. JP Morgan's almost completely flat on the day. Crude is down on the day. Kind of with everything else. Crude's kind of following the rest of the market. I'm in Exxon right now. We're green on Exxon, but we're red on the day today. All right, guys, get ready. Get ready. Hey, thanks, team. I appreciate the love. Thanks so much. Shout out to Joe. Now, they said I could gift my subscribers a certain amount of memberships. I wish I knew how to do that today. Does anybody know, as another fellow YouTuber person? YouTube, custom emojis, membership gifting. Never mind. I'll have to figure it out. I think tomorrow I'll be able to do it. So join our stream tomorrow. Tomorrow we got jobless claims. Remember, guys, again, we're going to stream the entire press conference, so stick around. We got 12 minutes. 12 and a half minutes. Remember, tomorrow we got jobless claims, U.S. productivity, S&P manufacturing, PMI data. So a very busy day tomorrow as well. And then Friday, the big boys come out with payroll numbers, unemployment numbers. And again, with the labor market being really strong right now, with JOLTS numbers coming in high, look at gold starting to move up. The interesting state is what the interesting state of the labor market is going to be something that's going to be super influential, in my opinion. Like we're gonna pay a lot of attention to jobs and the economy moving forward. I think that's something that Powell will probably talk about today, is what the labor market looks like. So yeah, it'll be fun. We'll see what happens. Again, do you guys think Powell is going to be hawkish or dovish right now? Hawkish or dovish? It sounded like in the basic FOMC release. Like here's today's FOMC release, right? What he said, just to look at, he said recent indicators suggest that the economic activity has been expanding at a solid pace. Job gains moderated since early last year, but remains strong, and the unemployment rate has remained low. Inflation has eased, but remains elevated, is what he said, right? So that's something to consider. He still says inflation's elevated. He did say the economy is moving at an active, or at a solid pace. Job gains have moderated since early last year, which is good, but remain strong. And so again, he did say that jobs have gotten a little bit better. He did say jobs have gotten a little bit better. The market's starting to come down. Bitcoin coming down. Gold's still holding a little bit, but look at the NASDAQ start to fall down a little bit here, team. So, interesting. Nice, guys. Thoughts on AI future? I think AI is the future. I think it's going to be very influential technology. I think it's going to replace jobs. I think it's going to create a huge boost over the next 10 years in productivity and output in terms of technology. As a software developer myself, like I'm a JavaScript, React Native developer. I can go to AI, and it's not perfect. It's still kind of spaghetti code, but I can go to AI and be like, yo, write me ABC React Native application, and it'll spit that thing out in like 20 seconds. And so I think that's a very powerful thing, and I think over time it's going to get better, and it's going to cause huge technology output over the next 10 years versus what we've seen in the last like 30, in my opinion. And technology grows fast. But yeah, I think that's all going to be good for NVIDIA. The question is NVIDIA short-term extended on the upside? You know, NVIDIA at 615. AMD dropped earnings yesterday. I'm pretty sure reacted negatively to earnings. Yeah, so AMD red on the day, NVIDIA, Microsoft, a lot of that stuff was up so much that it's understandable for it to pull back a little bit, I think. Yeah. AI is going to ruin lives? Well, yeah, I mean, just the way the automobile ruined carriage workers, you know what I mean? Like, people who used to fix up carriages, I'm sure didn't like the creation of the automobile, you know? But tough. That's how life is. Get over it. You know, they're going to have to move on. Figure it out. Technology grows like that, and it always has. And so, you know, they'll be all right. But, yeah, again, when the carriage was replaced by the automobile, you had a lot of people out of work that fixed up carriages. Does that mean we should have stopped and pandered to them? No, of course not. You got to make what's efficient. Efficiency breeds everything else, right? And so technology and AI makes things more efficient. Same thing with EVs, I think, as well, but that's a different argument. EVs are simply more efficient than internal combustion motors. Lithium batteries might be more environmentally taxing, but we're going to mine lithium regardless. Emissions are better, speed is better, they mesh better with technology. But again, I also see the other side of it, which is, you know, it's a different argument. There's a lot more nuance there with everything else, you know. All right, guys. Hey, the Fed decision in about 8 minutes, team. 8 minutes. Why do you say AI will replace jobs? Why is that, and how can AI replace humans? Okay. So if, say I run a software company, right? And say I need somebody to create components of a React Native application for me, right? Historically, I'd have to hire somebody out to do that, pay them a high hourly wage, do all these different things. At this point in time, I can go to ChatGPT and say, yo, write me a React Native code that does this, 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 and this, and it's going to spit that code out in about 30 seconds, thus completely replacing jobs. It's also going to create jobs, though, is the other side of that. Like, it's also going to create jobs. It's going to create work. You're going to have prompt engineers and people who master AI and use that as well. And I think that's a great career path moving forward, because I think AI is very self-evidently the future of technology. But it's certainly going to get rid of some jobs as well, because you just don't need a certain amount of people to do it anymore. You know, I mean, again, it's going to create jobs as well. I think the technology growth from production increasing from what I just said, instead of having it's gonna be a lot faster to create game-changing technology now. I think we're gonna see a huge tech boost over the next 10 years. Yeah, again, it's still spaghetti code a lot of the time, Brian, but my point is that you can see the potential of it now, right? So right now, it's still pretty good. It's not perfect. A lot of it's spaghetti code, but over the next 5 to 10 years, they're going to optimize it and make it more efficient and make it better. And I think that's something that's very clear with how much money's being poured into AI right now. Anyways, NASDAQ still flushing down a little bit. Is right around the lows of the day here. I think this is the lows of the day. Never mind, not quite the lows of the day, but it's breaking down a little bit. The lows of the last hour or two are being tested right now on the NASDAQ. Gold is starting to flush down a little bit. Bitcoin right around the 43.4 level or so. Again, here's the NASDAQ 100 on the left side here. We still got 4 minutes. I'm going to put in my headphones here. Let me fix this. I work implementing AI in companies. Trust me, the economy of the future, not everyone. Yeah, I mean, and again, like, people act like AI is going to turn into Skynet and we're going to get a Terminator-like situation with sentient AI and stuff like that. And maybe, but, like, that's not the risk of it again. And the risk is that it replaces jobs that people have worked their lives to learn the skill of, right? So a lot of people have spent their lives learning specific skills, and those skills are going to be moot, you know, in 5-10 years. A lot of them are, not all of them, but like that's the risk. That's the negative impact of it. And again, I don't know if it's good or bad. I mean, it's good. We're going to grow technology. Things are going to get more efficient, better. But people are going to lose some jobs, almost certainly, I think. But again, jobs are going to be created too. You know, young people are going to be at the forefront of it because they're going to recognize the potential of it through technology, and they're going to, you know, a lot of stuff's going to happen. Can y'all hear the music? Or no, you shouldn't be able to. Let me reshare this. There we go. And make sure. Hold on. Here we go. Can you hear the music now? I just turned it back on. Can you hear this? Yeah, I mean, there's some big risks there as well, Malcolm. 100%, dude. I don't know if it's AI is going to replace lawyers. I think that you're going to still need lawyers and representation because I think people relate more to people in that regard, right? So I think jurors are always going to side more with a person putting out an argument versus AI. I don't think lawyers are going to be replaced. I think they're going to replace like medical coders. You know, I think they're going to replace software developers to a certain degree. I think they're going to replace tech jobs more than anything else, right? They're gonna replace information jobs that require extensive information about a particular subject is what they're gonna replace, right? And law is certainly one of those areas, but I think the nuance of law is that, you know, people are always gonna want to relate to a person more so, in my opinion. But maybe I'm wrong there. I could certainly be wrong in that situation as well. Real estate agents, sure. And I'm a real estate agent. I have my license at least. I don't really sell houses, but like I got my license. And again, certainly could replace real estate agents. Although real estate agents are contract writers. So, you know, you're always going to want a person to show you a house versus not having a person. And real estate agents write contracts. Although a lot of the groundwork is going to be replaced, in my opinion. Anyways, so we got the NASDAQ starting to pop up. Get ready, guys. We got 3 minutes or so, 3 minutes until the FOMC meeting. You guys ready? Look, we got this statement on longer run goals. All right, so they reaffirmed their longer run goals today as well, something the Fed just did. All right, guys, you guys ready? Again, make sure you guys can hear the music, right? Can you guys hear the music? Sound one check. NFT AI spouses? First, retail jobs probably will. I think we're already seeing that to a certain extent with fast food and stuff, but yeah. No, you can't hear the music? Here, let me try to fix it. Here. What about now? Can you hear the music now? Sound check 1 2 1 2. Okay, yes, you can hear it? Good. All right, cool. Yeah, it doesn't matter how high or low it is. I just want to make sure you can hear the FOMC meeting when it starts. All right, let's get this ready here, shall we? All right, guys, we got about a minute here. We are sitting here tight, waiting for the Fed. Waiting for the Fed. We're gonna get this screen up. Make sure you guys can hear this. There we go. All right, you guys ready? I'm gonna mute the background music and turn on the hold music. All right, guys, we got 45 seconds. 40 seconds, really. You guys ready? All right, 10 seconds or so until it's supposed to start. All right, here we go. I'm going to turn my music off in the background. Waiting for them to start. Waiting for their music to go off. All right, guys. Here we go. You guys ready? Let's wait for Powell to show up. Powell, where you at, dude? Again, hit that subscribe button, guys. Help me hit 124,000. There's my timer going off. What color is this tie going to be? Red tie means bearish action. Green tie means bullish action. He switched it up the other day and went with gray. Ooh, what does that mean? Purple tie the other day, too. All right, here we go. Here he comes. All right. Purple.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
So here's the Q&A section, your team. Market's flat.
Gina Smiley from the New York Times. Thanks for taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay. So what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6-month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%? That's really what we're thinking about. In terms of growth, we've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry, if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing, and that tells us that we are on, gives us confidence that we're on a path to a sustainable path down to 2% inflation.
Nick.
Market's flying.
Nick Timmeros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for 2 reasons. One was the risk of a wage price spiral. 2, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these 2 tail risks, and that you've judged here today current policy as well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now that you have avoided those 2 risks?
So, as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, you know, we feel like inflation is coming down, growth has been strong, the labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back down to 2%, so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or its variants. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, look, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our Teal book, and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is, implicitly, is so in theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all, because for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around for to see the economy turn down, because that would be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Howard.
Hi, thanks, Chair Powell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's still well above, core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline. And the case is likely that it will continue to come down. So that's where it is. But we're wanting to see, more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates?
Yes, so let me say that we're not looking for that. It's not something we're looking for, but yes, if you think about, in the base case, the economy is performing well, the labor market remains strong. If we saw an unexpected weakening certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things, would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down, that's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached. Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So, we're not at a place of really working out those kinds of details, because we weren't actively considering moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including,
Rent costs.
yeah.
Yeah.
Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rents, so of course we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation, so the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming, and we know it's coming. It's just a question of when and how big it'll be. So, but that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time. But it may well have some more time to run. The supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest-sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important, and that is a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that other set of factors is really different from other cycles and has brought that, working with tighter policy, which has enabled the supply side to recover, I think that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest-sensitive parts of the economy as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
So I think it's of course, that it's not something you can identify with any precision. But a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract a sort of a forward measure of inflation. If you do that, and there are many, many ways to calculate that neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will. But at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So I think the question is, when that peters out, I think the restriction will show up probably more sharply.
Thank you, sorry.
Interesting.
Thanks for taking the question, Mr. Chairman. You mentioned earlier we're not seeking a weaker labor market, I think that you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote-unquote normal, and that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic. Even with today's ECI levels, they were still above those pre-pandemic levels.
I think the
Good
labor
question.
market, by many measures, is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think, job openings are not quite back to where they were. Wage increases, rather, are not quite back to where they would need to be in the longer run. I would look at it this way, though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens, it's probably will take a couple of years to get all the way back. And that's okay. That's okay. But we do see, you saw today's ECI reading, the evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market is, I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. Panic on the part of businesses, couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, we were kind of thinking, well, maybe we won't get it back. And then 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to where it's still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance. And that's what we want to see. And one great way to look at that is what's happening with wage increases. And you see it now across the major things that we track. It isn't every quarter, but overall, there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk, the risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here, and why we're not rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months, but what's really going to shake out here? When we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. Yeah, we'll look at those. Last year was a surprise.
Yeah.
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, the other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below 2% inflation on a 3-month basis. Core PCE's been running at 1.5%. And there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
Pump it.
So your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment, indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years, so it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation, let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target. It's not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you
Under
have to
2%.
do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question, which we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
Good question.
I'll point to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, right, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case. Then your second question is
is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happened, that would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Victoria.
Hi,
Interesting.
Victoria Guido with Politico. Could you talk a little bit more about productivity growth? You've mentioned multiple times about, the level of wage growth that's consistent with 2% inflation. We've obviously seen, you were talking about ECI this morning, in which it's cooled a little bit, but still sort of above what you wanted to see. Growth has been very strong. How much of those numbers do you attribute to productivity, and do you see that productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about, or do you think that productivity growth will fade over time?
So this is a really interesting question, and I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast. And then you saw a deep trough of productivity. And then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy. And the question will be, what is it that has changed? The productivity tends to be based on, fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see, work from home doesn't seem like it's a big productivity increaser. AI, artificial intelligence, generative may be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but right now, I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force and activity returning and supply chains getting fixed.
Right, so would that be behind why we've seen such strong growth, but we've also seen inflation fall, that maybe there's just a higher level of productivity
That's
right
one
now?
way to look at it, yeah.
Nancy.
Interesting. Powell doesn't like AI.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected.
So when we think about, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but they're not, those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. We have a built-up set of cities, and people are moving further and further out. So there hasn't been enough housing built, and these are not things that we have any tools to address. But where it comes into play very specifically in our work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So.
And just real quick, what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly, not most importantly, mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation, in the necessities of life, right away you're in trouble. Whereas even middle-class people have some scope to absorb higher costs. So we have to it's our job, it's what society has asked us to do, is to get inflation down, and the tools that we use to do it are interest rates. So that's how we think about that.
Courtney.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes. So I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions of balance sheet issues at our next meeting in March. So those questions are all coming into scope now, and we're focusing on them. But we're at the beginning of that process, I would say.
Quick follow-up, is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
Yes, we do. We see those as independent tools, and so they don't. For example, if you're normalizing policy, you might be reducing rates but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one with tightening. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet runoff to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
Yeah, I'm not in a position to put a number on it. I'm just going to say, it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction, and we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications, and we won't keep that a secret.
Hi, Chair Powell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to 0, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to 0. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's what we'll be talking about at the March meeting. A whole range of issues will be briefed up, and the committee will get into all of the issues that will be arising over the course of the next, let's say, year or so.
Greg.
Thanks, Greg Robb from Market Watch. Chair Powell, I want to change gears a little bit. In the presidential primary campaign that's been going on for the last 9 months or so, your name has come up often, and many Republican candidates had said that they probably wouldn't want to give you a 3rd term. So I wanted to give you a chance to talk about that. Do you want another term? You've had on the Fed. What's your stance on that?
I don't have a stance on that. It's not something I'm focused on. Focused on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on doing our jobs.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you mentioned, core PCE has been running at 1.9% over the past 6 months, and you guys are actually expecting core inflation higher this year at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten. So look, as I mentioned, we're going to be reacting to the data. If we get very strong inflation data and it kicks back up, then we'll go slower or later or both. If we got really good inflation data soon, that would matter for both that would tell us that we could go sooner and perhaps go faster. So we're just going to be, but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more, perhaps, than you already have factored in?
Well, I think if we came to the view that that the 6-month inflation numbers, which are very close to 2, were in PCE world, if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point, is we're trying to get comfortable and gain confidence that inflation is on a sustainable path down to 2% or toward 2%.
Daniel.
Hi, Chair Powell. Daniel Davis, Agence France-Presse. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years, but nonetheless that's been the case, and we've asked ourselves why that is, and one on to have perfect wisdom on this but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why people are unhappy, and they're right to be unhappy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But it is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Thank you for taking our questions. Brian Menace, CNN Business. Committee members have said they'd like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that some data are subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes. I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy, and I always feel like I spent most of my life in the private sector looking at individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone. That in all their districts, they're talking to not just the business community, but the educational, medical, all nonprofit community. They have arms into all of that, and so when they come back, that's what goes into the beige book. But that they come back, and what each reserve bank president does is during the Outlook go around, they'll say in my district, and they'll talk about 100 conversations. They won't talk up. They will give you input based on 100 conversations that they've had with people of all different walks. And I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them notice slowing economy based on what they've heard from their district?
Yes, I mean, if you look back at the last, not this beige book, but the one before, it was more, there was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing, not in every district and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what comes through.
Let's go to Jeff Cox for the last question.
Thank you, sir. Jeff Cox from CNBC.com. Just kind of looking to put it all together. You talked about basically the economy looking strong. We had 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And then also, perhaps, are you worried at all that the economy is maybe a little too strong right now and that inflation could come back at some point?
I'm not so worried about that. It's, again, we've had inflation come down without a slow economy and without, important increases in unemployment. And there's no reason why we should want to get in the way of that process if it's going to continue. So I think declining inflation, continued declines in inflation, are really the main thing we're looking at. Of course, we want the labor market to remain strong, too. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate, and those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
All right, team, so that is the FOMC meeting for Powell. Let me know what you guys think about it. Don't go anywhere. We are going to be doing a crypto show talking about the biggest updates in crypto. Again, let me know what you guys think about this. Powell, again, taking a hawkish tone, as I told you guys he would. I said the hawkish tone. I said we're going to get a pause and a hawkish tone. Boom. Exactly right. Market's down a little bit. People acting like this is some type of parabolic market crash, though. Like, let's not exaggerate. The market's down like 1.5%. It's not the end of the world yet. Again, market's been up a ton over the last month. We'll see what happens moving forward. Before we go anywhere, though, guys, we're going to do a crypto show today, so do not leave. As soon as we close down the stream, it'll route you to our crypto show. And so don't go anywhere. But before we do that, we got to talk about a couple sponsors. Our first one is a company called Chart Prime. It's a trading view indicator service you can use in stocks, crypto, Forex, futures. Honestly, I'm so impressed. This is an hourly chart. This is an hourly chart on the S&P, on the SPY, on the E-mini. S&P 500. And again, look at how powerful this is. Every candlestick represents an hour. They are a sponsor of mine. I'm certainly biased in their favor because they pay me money. And so, of course, I'm going to be biased and can't guarantee any results or anything like that. But look how powerful this is. Look at the strong ones as well. The strong indicators, very high accuracy. But again, let's just back test this real quick just to show you guys this. All right, look. Bearish, strong sell signal, huge drops. Buy signal here, called right at the bottom, huge bounce. Sell signal there worked. Strong buy signal, again, the strong ones, huge rip. Sell signal there, rip down. Strong buy signal here, we got a nice little bounce moving forward. And this is like days of price action sometimes. Sell here, we had like 10 hours of negative action. This one was wrong. Look at the strong signal here, beautiful breakdown. Look at the buy signal here, literal days of green action. Days of green action from that. This is an hourly chart. I can use them on any time frame that I want. Sell signal there worked. Strong buy signal again worked. Look at the sell signal. This one came in much earlier on the day, and we've had a downward trend for hours and hours and hours. Genuinely impressive. Again, genuinely impressive. You can also use it on a short-term chart. Again, here's a 5-minute chart with Chart Prime with today's recent price action. And again, I can't guarantee anything, but like, look, I can't fake this. Look, strong signal, boom, beautiful breakdown. Buy signal here, beautiful rip up. This is a 5-minute chart, so this is like 30, 40 minutes, an hour plus. Strong signal, again, boom, worked. Buy signal, again, boom, worked. This one may be wrong. Strong signal worked, short signal worked as well. I can't fake this. I can't guarantee you're gonna make money, but there's so much other stuff that they offer. They offer oscillators, screeners, back testers. It's like $40 a month. So try it out on your favorite security, on your favorite symbol. See if it works for you. Again, I can't guarantee it will, but I'm genuinely impressed. Although, again, they are a sponsor of mine. I'm biased in their favor. The other sponsor I have is a company called Top Step. Again, I'll put this link up if you want to check them out. Great way to help support your boy here in this. Great way to help support your boy here in this channel. Check out Chart Prime. Here is the link. We'll put it up in chat. Again, you can also. Sorry, man. I'm hitting the wrong link here. I accidentally put something else in the link. But yeah, here's Chart Prime's link. Let me delete the last one. Try out Chart Prime. You get 40% off if you use my link. The other one is a company called TopStep. Remember, guys, I have no idea what I'm talking about, and I'm wildly wrong about anything and everything, but this is a company called TopStep. It's a funded account program in futures. If you want to check out Chart Prime, there's the link. But remember, I have no idea what I'm talking about. I might be wildly wrong about anything and everything I say. TopStep, if you want to day trade, TopStep's the most legit funded program in the world. They give you a demo in futures, and most people trying to day trade should be trading futures. There's no PDT rule. You can day trade short, buy market, sell market in futures. Like if I want to day trade, I can buy market, sell market, short, just like stocks, but there's just no PDT rule. I can day trade the S&P, essentially the SPY. I can day trade essentially the QQQ price action, what's called the NASDAQ. This is basically the Q price action here. Long and short, no PDT rule in futures. TopStep gives you a demo, and they test your skill. And if you can pass the test, they fund you. If you can't pass the test, you're probably going to lose less trying this out, learning how to trade. Great test of skill. If you're good enough to pass it, great. You can get between 50 to 150K in funding with a 90% split. And so if you get funded, you're keeping 90% anyway. But if you lose, you're losing much less. The patterns are very similar to large cap stocks, but again, there's just no PDT rule. You can day trade short in the S&P 500, NASDAQ, gold. A lot of ways you can do it. Great way to help support the channel as well. Although, again, guys, remember, I am super biased in both of these companies' favor because they're sponsors of mine. They pay me money. Check them out. Again, we're going to move over to our crypto show today, and so don't go anywhere. If for whatever reason the live stream doesn't work, if for whatever reason the live stream doesn't work and it doesn't redirect you to if it doesn't for whatever redirect you to our crypto stream, don't fret, friend. Don't fret. We'll post the link here right now, guys, and see if yeah, we'll post the link here right now, and yeah, you don't have to do anything. You just join that stream. Let me make sure this is set up. Yep. All right, and yeah, you won't have to go anywhere, guys, anywhere. Again, FOMC decision. What do you guys think before we leave and move over to the crypto stream? Let me know what you guys think here, team. Do you think the market's going to rebound? And we've been mostly sideways. And yeah, sorry, I'm making sure to get the last keywords in. All right. All right, guys. So again, you won't have to go anywhere, guys. You won't have to go anywhere. Get out the way. Let's see. Live trading. All right, team. All right, yeah, and again, so we're going to be talking about everything in crypto, all that good stuff. Again, if you haven't already, team, the last thing I'm going to say before we move over to this crypto stream is remember, if you haven't already subscribed here, team, I think we're going to hit 100 and again, as soon as we end the stream, here's the crypto channel if it hasn't already shown you. Here's the crypto channel, so if you don't go anywhere, here's the link. Check it out. There's the link in chat right now. So again, there is the crypto link. If it doesn't bring you there for whatever reason, there's the link. We're going to be starting up this stream right now. Also, guys, thank you so much. I'm pretty sure we have broken 124,000 subscribers on beginner trading. If we haven't, just hit the subscribe button. Everything we do here is free. Tomorrow we have Apple, Amazon, Meta earnings. We're going to stream all of that live. Tomorrow we also have jobless claims, a bunch of stuff, ISM, PMI data as well. But again, I'm pretty sure we have broken the 124,000 subs. That makes us 100, and that gives us, again, 100. That gives us 1,000 subscribers just today alone. 1,000 subs just today alone, guys. And so again, we're going to go over to the crypto show. You don't go anywhere. As soon as we close this stream, it's going to bring you over there. Yeah, I type 100 words a minute. I've done it on stream before. So if you think I'm faking it, you know, joke's on you, sir. But anyways, guys, again, if it doesn't bring you there for whatever reason, go to this channel right here. Again, listen, I'm going to ask you guys a favor. When we go to the crypto show, subscribe. All right, help us hit 3,000 subs today. We got 2,000 people here. Go over to the crypto show. Again, here's the crypto show link right there. Again, as soon as we close down the stream, it's going to bring you to the crypto show. If it doesn't, there's the link in chat right there. And yeah, y'all be good. I'll see you guys over there. Y'all be safe. Appreciate the love, guys. Thanks so much. I don't know if you should buy gold or not. I have no idea what I'm talking about. I'm wildly wrong about everything. Remember, guys, before we leave, I'm just going to put this up one more time. Remember, I'm terrible at this stuff. I have no idea what I'm talking about. You know, just always remember this rule right here, which is John does not know. If you're going to ask me, is gold going to go up, down, or sideways? Remember, I don't freaking know, bro. That's the rule. I'll see you guys over there. Again, we're starting the new live stream up right now. We're starting the new stream up right now, guys. We'll see you guys there.